Welcome back to the channel. In today's episode, we will go into a topic that has been generating a lot of buzz in the investment world, investing in China. Now, I'm aware that there are many content creators out there with strong and often divergent opinions on this matter. Some have taken bold positions by heavily investing in Chinese stocks, while others caution against it, advising investors to stay away. But what's the real story? What factors should we consider when looking at the Chinese market? In this video, I will walk you through the reasons why I'm allocating a portion of my portfolio to China this year. We will explore the complexities and potential opportunities that the Chinese market presents, covering both risks and the rewards. Let's dive deeper into the numbers. Right now, China's market cap is only about 3% of the world total. That's a small percentage, especially when you compare it to the United States, which stands at 61%. But why is there such a disparity? Well, it is not entirely surprising when you consider the performance of Chinese stocks, which has been underwhelming since the regulatory crackdown began in 2021. This downturn has inevitably led to a smaller market cap. But let's broaden our view to other emerging markets. How does China stack up against them? For instance, if we compare China with India, we see a big contrast. India has significantly outperformed China over the recent years. This begs the questions, are all emerging markets performing equally poorly? The answer, it seems, is a clear no. Now let's take a step back and look at the bigger picture. Is China's economy really as small as market cap suggests? The market cap of the US is 20 times larger than that of China, but does this reflect their respective GDPs? China's nominal GDP is currently the second largest in the world, approximately 2/3 of the US GDP. This brings us to the growth rate. China's historical GDP growth rate has been remarkably high, indicating that the country's economic policies are propelling it in the right directions. And if we switch our focus to the purchasing power parity, China's GDP actually surpassed that of the US. Some might argue that China's GDP growth has slowed down in the recent years. While it's true that the growth rate isn't as high as it once was, it still maintains a respectable rate of about 5%. This shows continued economic momentum. But what about GDP per capita? Here, China still lags significantly behind the US. However, the gap is closing as China's GDP per capita continues to grow steadily. This indicates a huge potential for further growth. So why then the stock market performance has been so bad? There are numerous theories ranging from the economic policy missteps and the government rectifications to the ongoing trade war with the US. However, I believe the most significant factor is the recessions in the real estate sector, triggered by the government policies aimed at cooling down the property prices. This move, perhaps too aggressive, has had a profound impact on wealth and public confidence. The real estate sector is crucial and its current state leaves us uncertain about the future. We can only hope that this is a temporary setback and the growth will resume soon. Now let's address the questions. Which investment should one pick to gain allocations in China? My choice is an ETF that tracks the MSCI China Index. This index is comprehensive, covering both China A shares and H shares, providing a broad exposure to Chinese market. However, a glance at the historical returns paint a sad picture. From 2021 to 2023, the returns have been negative for 3 consecutive years. This persistent downturn has led to a significant drop in the index. In fact, the drawdown from early 2021 is staggering negative 57%. It is no surprise that sentiment towards China has become overwhelmingly bearish. It is human nature to feel bullish about investment that has increasing in value and bearish about those that are underperforming. But who are the key players in this index? The top 10 stocks in the MSCI China include major tech companies like Tencent, Alibaba, Pinduoduo, Meituan, Baidu, and the gaming giant NetEase, and large banks like ICBC and Bank of China. These are heavyweights in the Chinese economy, each with their own unique impact and story. I understand the skepticism some of you might have regarding Chinese companies, fueled by the belief that the CCP regulatory crackdown will continue. However, let's consider this. Many of these governmental rectifications commenced 2 to 3 years ago. If this policy were truly detrimental, we should expect to see a decline in the fundamentals of these companies. In the upcoming slides, I will walk you through the profit of these firms, providing a clearer picture of their current health and performance. Let's start from Tencent. It seems that the profit has been going up, but now at a slower pace. Alibaba, I think their performance was quite volatile, especially during the period about 2022, but now it has recovered. Pinduoduo result is just fantastic. The profits was negative for quite a number of years, and in the recent 1 to 2 years, it has skyrocketed. For Meituan, which is the company that I still own, yes, the result has been quite volatile, but we have seen some recovery in the recent year. China Construction Bank has been going up steadily. NetEase profit also has been going up steadily, but I think people are concerned about the crackdown that just came out recently. Baidu isn't doing that well. It has been fluctuating up and down, but I think the result isn't that concerning. JD also same. JD result also very volatile. I think the competitions at the e-commerce sector is just too great. Over the recent quarters, it is still positive. For ICBC, the result has been going up steadily, but it seems that flattened up in the recent quarters. Similar picture for Bank of China as well. That's all I have for this video. I hope that you like the content and remember to like and subscribe. See you in the next one. Bye bye.